Street today. NVIDIA upgraded to buy from neutral at D.A. Davidson. The price target also raised to $210 a share. It was $190 before. D.A. Davidson's also downgrading Apple to a neutral rating from a prior buy. The price target there stays at $250 a share. Let's now bring in the analyst behind both of those calls. Gil Luria is managing director at D.A. Davidson, covers a lot of ground in technology. Gil, thank you very much for being with us here on Power Lunch. Let's go one by one, and then we'll delve a little bit further into the discussion. Let's talk NVIDIA first. This has been a consensus trade, I think, for quite some time now. NVIDIA has been the poster child of AI. So what's behind the upgrade, and why exactly do it now after we've seen the kind of run that we've seen?
Well, that's right. It has been a consensus, and it should be. But a couple of things have happened as far as we're concerned. A couple of things are converging. One is we are exceedingly optimistic about the adoption of AI and the needs for AI compute. There's some worry about why isn't it implemented in organizations. We don't think that matters. We are bringing AI to the workplace. I sat in my car and during a commute and learned about government subsidies of chips from Grok. I was able to download a 400-page document and extract the piece of information I need. My neighbor, the lawyer, is not only replacing paralegals and associates, but she's now getting strategic advice from ChatGPT. So that's all happening. But what's happened at the same time is people have tried to expand the AI trade away from NVIDIA and Microsoft to a point where now NVIDIA is the least expensive in the AI trade. They're only trading at 28 times next year's earnings. Oracle's trading at 50 times, 50 on a much less, on a much more questionable story. And yet NVIDIA is now trading at 28 times. Apple is trading at 28 times. NVIDIA is going to grow earnings 40%. Apple is going to grow earnings 10%. So between our optimism for AI and the fact that the AI trade has rotated away from NVIDIA, we think this is the time to focus back on NVIDIA.
All right, so the risk-reward setup, given that, is going to be one that you're focusing on. And like you said, 50, half 100, that's nothing to shake a stick at there.
The market share of GPUs and AI accelerators used in data centers is dominated by NVIDIA. Only a small number of clients account for the great majority of NVIDIA's revenue. The move to bespoke AI accelerators might be one of those clients. Over the past 3 years, NVIDIA has arguably benefited the most from the explosion in AI advancements. The company is now the most valuable in the world, with a market capitalization of almost $4.3 trillion. This is due to the sustained demand for its industry-leading graphics processing units, GPUs, which are necessary for the training and inference of massive language models. According to its financials, NVIDIA is a huge business that continues to develop at an accelerated rate in both sales and profitability. However, a few recent events have raised doubts about how long NVIDIA can maintain its rapid growth. One of its largest clients just struck a contract with one of NVIDIA's most formidable rivals. Even while NVIDIA's revenues have increased due to large tech businesses investing whatever it takes to be at the forefront of AI development, the great majority of its revenue comes from a small number of customers. Just 2 direct clients accounted for 39% of NVIDIA's second quarter sales, while 6 customers accounted for 85%. Naturally, only a limited number of businesses can afford to invest the money required to construct data centers. Numerous large clients of those companies, such as Microsoft, pay for access to those NVIDIA CPUs via their cloud computing platforms. NVIDIA's risk of client concentration is therefore not very high. Nevertheless, investors should take this important risk aspect into account. That recently gained attention due to reports that Broadcom and OpenAI, one of the largest organizations utilizing NVIDIA's chips, are developing a unique AI accelerator chip. The allegation comes at the same time that Broadcom announced that it had already won $10 billion in orders from a new qualified client for specialized AI chips. A significant change for Broadcom would result if OpenAI were to become the company's new client. The Stargate project, which is spending $500 billion in AI infrastructure between 2025 and 2028, is led by the pioneer of generative AI. Notably, NVIDIA was listed as a technology partner in the announcement, but Broadcom was left off. The change has already begun. It's possible that OpenAI is not the only business hoping to lessen its dependency on NVIDIA and employ more custom silicon solutions. According to Broadcom CEO Hock Tan, the company is still gaining market share among its 3 other clients for specialized AI chips, which are ByteDance, Alphabet, and Meta platforms. According to Fubin Research, Microsoft is also apparently planning a significant increase in the use of its next-generation custom accelerator, which could lead to orders worth $10 billion to $12 billion in 2027. The revelation also comes after OpenAI recently inked a contract to use its tensor processing units, TPU, which were also created by Broadcom, with Alphabet's Google Cloud. Recent research from Google found that the average energy consumption of a text-based AI prompt was only 0.224 watt-hours, which the company characterized as substantially lower than many public estimates. Additionally, it reported a 33-fold increase in efficiency in the previous 12 months. The researchers attributed its effectiveness in part to Google's TPU processor. Moving away from NVIDIA's architecture might save OpenAI a lot of money, given its size. Investors should ask themselves if the market has adequately priced in NVIDIA's possible share loss and other chipmakers' possible gains. The current price of NVIDIA stock is approximately 38 times its projected earnings, which is still more than its average since the beginning of 2023. That's even though it's improbable that NVIDIA's earnings growth would continue as it did the previous year and the year before. However, that does not imply that Broadcom is currently a good deal either. Following the announcement that it had secured a significant new contract, shares had surged above 50 times earnings. Additionally, even though custom AI chips are a significant source of income and profits, it's crucial to keep in mind that the company also has a reasonably developed software business and that only around half of its current semiconductor sales are tied to AI. Broadcom is currently priced as though all of its revenue comes from AI-related expenditures, but over time, this will have a bigger impact on the company's overall performance. As a result, both chipmakers currently appear pricey. Despite the market price, Broadcom appears to have more upside potential than NVIDIA if you had to choose between the two. Investors might still choose from a wide range of other AI stocks with more attractive prices. The market leader for AI graphics cards is NVIDIA, whereas Broadcom is seeing growth in demand for its own AI chips. Both businesses should be able to maintain steady growth rates in the long run thanks to the enormous end market potential in AI chips. From the perspective of valuation, one of these two equities is currently more appealing. The market for artificial intelligence, AI semiconductors, is dominated by NVIDIA and Broadcom. Both chip designers have been experiencing steady growth because they are the industry leaders in their respective AI chip segments. In terms of AI processors, NVIDIA and Broadcom are clearly well ahead of their competitors, including Advanced Micro Devices and Intel, according to their most recent quarterly results. However, which of these two semiconductor companies should you purchase now in order to profit from the rapidly expanding AI chip market? When it comes to AI graphics processing units, GPUs, which are utilized in data centers to handle AI workloads, NVIDIA leads the industry. The company's CPUs are now being used for AI inference applications, and its graphics cards are crucial for training large language models, LLMs. According to John Petty Research, at the end of the preceding quarter, NVIDIA held a commanding 94% of the global GPU market. There are two reasons why NVIDIA has such a strong hold on this market. The business has a technological edge over its competitors, to start. 3 years ago, it gained notoriety by supplying its A100 GPUs for ChatGPT training, and it has since consistently improved its products. The company's 7nm nm platform was used to create the A100. After that, it introduced the 5nm-based H100 Hopper GPU, which quickly became a huge success when it came to managing AI workloads. Additionally, it claims that its most recent Blackwell processors are 2.5 times quicker than Hopper processors. Although rival AMD has been catching up, it hasn't been able to seriously challenge NVIDIA's lead thus far. This leads us to the second explanation for NVIDIA's supremacy in AI. NVIDIA receives the majority of its manufacturing capability from its foundry partner, TSMC. According to third-party allegations, TSMC has set aside 70% of its advanced chip-making capacity for NVIDIA, while producing chips for all of the top AI chip makers, including Broadcom. As a result, NVIDIA is well positioned to serve the enormous AI chip industry, which is predicted to add $3.1 trillion in revenue by 2030. Crucially, NVIDIA's supremacy is resulting in remarkable financial expansion. Revenue for the first half of the current fiscal year was $90.8 billion, a 62% increase over the same period last year. Analysts predict that NVIDIA would generate $206 billion by the end of fiscal 2026, a 58% increase over the previous year. The good news is that, given the multi-trillion-dollar potential in the AI chip industry and the company's ability to hold on to a large portion of this market, it can continue to grow at a healthy rate in the long run. All of this points to NVIDIA's potential to stay a leading AI stock for a very long time. In AI data centers, application-specific integrated circuits, ASICs, are also becoming increasingly popular in addition to GPUs. Unlike general-purpose processing chips, GPUs, these chips can be tailored to carry out particular tasks. ASICs' unique characteristics allow them to carry out the tasks for which they are designed with more power and efficiency. In order to reduce their operational expenses, many cloud computing and artificial intelligence firms are now making large investments in custom AI processors. The majority of these organizations are using Broadcom to assist in the design of these chips. According to reports, Broadcom owns 70% of the ASIC market. Its remarkable expansion can be explained by this. In the most recent quarter, the company's AI sales jumped 63% year over year to $5.2 billion. As a result, its total revenue increased by 22% annually to $16 billion. Broadcom's AI revenue is expected to reach $20 billion by the end of the current fiscal year, up from $12.2 billion the year before. Wall Street analysts predict that its AI revenue will more than double next year, which is not surprising given that it has begun shipping its customized AI chips to a fourth customer. After making a $10 billion order last quarter, OpenAI is reportedly Broadcom's newest client for specialized AI chips. There is enormous potential for Broadcom to increase its AI income in the future, especially because the company is working with 3 more cloud hyperscale clients to create AI ASICs. Earlier this year, management noted that the value of its serviced addressable market, SAM, from its initial 3 hyperscale clients alone will reach $60 billion to $90 billion over the following 3 years. Given its strong market share, the prospective addition of additional clients could expand that addressable opportunity and eventually assist Broadcom in greatly increasing its AI revenue. Analysts' forecasts for sales growth have been considerably raised, which is not surprising. Because they both hold a sizable portion of the market for AI chips, Broadcom and NVIDIA are expected to have impressive growth. Nonetheless, one of these two stocks is far less expensive than the other. Even while NVIDIA's bottom line is expanding far more quickly than Broadcom's, the company still has lower profit multiples. Last quarter, NVIDIA reported a 54% year-over-year increase in earnings, which was far greater than Broadcom's 36% growth. Therefore, investors seeking a balance between growth and value could think about purchasing NVIDIA at this time. However, investors with a greater tolerance for risk may want to include this growth company in their portfolios as well, as Broadcom's robust AI revenue stream may enable it to justify the premium it is selling at. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Okay, all right, KG, let's talk about these records. You know, you finally got the Dow in the party here. What do you make of all this and how sustainable it is?
I mean, if you kind of look at the trading from yesterday, we did see a broadening out of this rally here. A lot of participation. I believe over 80% of the S&P 500 was actually in the green. And if we continue to have days like that, even if we have maybe a little bit of a pullback when it comes to information technology, if you have other sectors that are able to kind of take up some of that slack, then obviously that provides a really decent environment for the markets to continue to move higher here. And we're getting fairly close to another key level, this 6,600 level for the S&P 500. We're basically only about 15, 20 points away from that right now. now. That'll be a really key area of resistance. Let's see if we're able to break through that here today. But the market is obviously optimistic when it comes to the rate cuts that is priced in for the remainder of the year. In fact, if you kind of look at the October rate cut expectations, it's sitting at around 80, about 82% right now for another rate cut in October, and then over an 80% chance that we get another one in December. So the market is pretty locked in when it comes to this trajectory for the Fed. Now, what I would say though, Diane, if you probably see a little bit more of an aggressive rate cut, being priced in for the remainder of the year, that probably will then be a bad signal from an economic standpoint. Let's see how the market actually reacts to that. But for right now, you do have the setup on an economic standpoint for the Fed to cut rates, which is why you're seeing this broadening out, as well as small caps and mid caps really participating right now.
When you say aggressive, do you mean more aggressive than the views that we'll actually have 3 this year?
Yes, yeah. If you were pricing in 100 basis points worth of cuts, that would be actually fairly aggressive. You're then starting to match the 07, 08 rate cut cycle, as well as looking at the early 2000s. And so that type of an aggressive rate cut regime in such a short amount of time generally also results in equity markets actually pulling back. And it's not because of the fact that we have this all clear when it comes to inflation. Obviously, we had the CPI report yesterday. Month over month for headline CPI came in hotter than the street's expectations. But the worry about the labor market with the initial claims number coming in a lot hotter than the street's expectations is obviously fueling that rate cut expectation here. And once again, if you price in about another rate cut for this year, if you just look at the past and look at that trajectory, usually doesn't spell profits, or it doesn't spell new all-time highs for equities. Usually it's a pullback that actually does ensue.